Hey everyone, welcome back to Upside Down Data. Today I want to give a bit of a holistic view of the market and where we stand right now. So I had been quite busy, hadn't been able to put out as many updates as I would have liked, but now I'm back and I want to talk a little bit about some of the things that have happened, since the last time I posted, then also, what we might think about going forward from here. Probably the biggest thing that happened, kind of in the meantime between my last post and when I'm recording this video is this kind of epic battle that Bitcoin has been doing with its 50-week moving average. That's this green line I just added to the chart here. And also its 200-week moving average, which I just added over here as well. You can see that there was this kind of intersection between the 50-week moving average and the 200-week moving average, where they're both in roughly the same spot. And lo and behold, that's basically the exact same region where Bitcoin stalled. We're in this kind of continuation attempt of this broader rally that we've been seeing from the beginning of the year of 2023, really stalled out, at least so far, and has now been correcting. And now I think the question that we're going to be asking is, does this mean that there's this rejection, this definitive rejection off of these moving averages, and that's going to send Bitcoin down and maybe the rest of the crypto market? Or is there a different way that we can look at that? So what I want to do is talk about some additional indicators that we have at the channel and on polaritydigital.io, our website that we put out in collaboration with Jay over at Daily Crypto Analysis, and some other factors. So before we get into some of our indicators that we have, one thing I did just want to point out is, what do things look like if we just look at the total crypto market cap? So not just Bitcoin or the price of Bitcoin, but just the market cap of all of crypto, and how is it relating to these moving averages that I just talked about. And if we look at this, we get a slightly different story than what we saw with Bitcoin. So again, red is the 200-week moving average, green is the 50-week moving average. What you can see is that we're actually, for the total crypto market cap, we're actually above its 200-week moving average. We actually went up, we kind of came down and more or less found it as support here. We actually broke a little bit below it, but more or less bounced off of it, came back up. And then though we didn't quite get back up to the 50-week, we kind of more or less got rejected off of that rough level. And now we're kind of trading in between these two. But what's useful about this is that with Bitcoin, a lot of people have been talking about the 200-week moving average as this really big wall of resistance that if we can't get above it, we can't be bullish. But in some ways, it's questionable whether or not we should be treating Bitcoin as being the only things we care about. Maybe we should be looking at the market as a whole, crypto market as a whole, and see what it's doing to get some evaluation. And so I think, depending on your bias, you might, frame one as being more important than the other. I think bears will look at this and say that Bitcoin's screwed and the crypto market's screwed and everything's going to go down and take out the lows, or, that'd be the more extreme stance you could have. Whereas with the total crypto market cap, here, the bulls could look at this and say, hey, look, we're trying to turn the 200-week moving average back into support like we did, for example, back here in July of 2022. And like we attempted to do, back here later on that year, although, it was a little bit more wishy-washy, not respecting that level as much. And then we decisively broke down below it into the November lows. But essentially, you could say we're just trying to reestablish it as support like it was over here, which could set the stage for more upside to come. And so I think that's a useful perspective to have, not just only what Bitcoin's doing. I think a lot of people, and I'll admit, me, myself included, take Bitcoin as the end-all be-all of the broader crypto market's health, and what it's doing as being the most important thing. And though I still think that Bitcoin is obviously the most important crypto asset, sometimes it tells a different story than what the entire market tells when you look at the total market cap. So it's useful to keep both data points in mind, in my opinion. So let's flip over to our website, though, and kind of go metric by metric across the different indicators that we have here, the ones that are the proprietary indicators, the ones that are specific to the website, and just talk a little bit about what they're saying and how we should be thinking about them. So let's go ahead and start by talking about our risk indicators, the upside downside potential indicator, both in the short term, which cares about moves that play out over days to weeks, medium is weeks to months, and then long term is months, multiple months, more macro time scale. So the first observation I wanted to make with these indicators was that they're telling slightly different things across the different time frames, so short, medium, and long. So let's take, for example, the UDPI short. Well, one of the things you'll notice is I've sorted the dashboard just by clicking on this. You can go ahead and sort the dashboard. I've sorted it by highest value to lowest value. And the first thing you're going to notice is that every single asset has a negative UDPI short right now. Tezos is the highest, but it's still negative, negative 0.35, all the way down to the Sandbox, which is all the way down here at negative 3.29. And so it's the story that's telling us is that really in the kind of the short-term horizon, the market as a whole is kind of oversold from the market's perspective to varying degrees. And so in the short term, we're definitely seeing this correction starting to manifest. Now, we're not at super extreme levels yet, right? The ones, this is the one I was meant to look at. The lowest one is at negative 3.29. The lowest value that's possible on the scale is negative 5. So we're not at hyper extreme levels yet. So this is not to say that this is a signal that we have to be finding a local bottom here and bouncing in the coming days to weeks. What it is saying is that, we're certainly not overheated in the short term like we were if you were following the channel back through this phase through here. Things were starting to get quite overextended to the upside in the short term during this phase. We kind of had to cool off, which then allowed this bounce to happen. And so now I think the question that people are going to be asking when looking at that is this just another cool off period that we needed, another consolidation before the next leg up can happen? Or is this time a little bit different? And when we're asking that question, I think actually looking at the other time frames helps us inform that decision. So this is all just in the short term, which tends to be very volatile, kind of bouncing around a lot, really keying into shorter term volatility in the markets. Let's now flip over to the medium term and then the long term and get a sense of what they're telling us. And they're now telling us a different story than they were telling us back in this phase of the market over here, leading into this bounce up here. So if we look at the medium term UDPI, we can see that a number are actually above zero here. The red numbers here basically will flip red if it's above zero, green if it's below. Now, a number of them are down in the green, but you'll notice they're not as extreme as we're seeing on the short-term UDPI on kind of the lowest values. The Sandbox, again, being the lowest at negative 2.43. But, a lot of these are hanging out kind of between negative 2, 0, and then actually going up to just under 1. And this is actually a very different profile than we saw during, the last big move up, the last big run, where a lot of the medium-term UDPIs were still sitting below 0 and some being quite a bit deeper down lower. That has now changed. Basically the medium-term outlook has gotten less favorable to assets across the board, at least of all the ones that we're tracking. And the exact same story is playing out with the long-term UDPI, actually maybe even to a more extreme degree right now. So this is, again, sorted by highest first, going down to lowest. To the lowest is XRP at negative 2, but all the rest of them are above negative 2, with a lot of them actually hanging out kind of between negative 1 and 1, with a few being above that. And this is important because the long-term UDPI is really focused on those more macro kind of indicators, the moves that are going to play out over multiple months. And when you see the long-term UDPI getting really extended to the upside, that's a time to become concerned. Because what it's saying is that in kind of the macro time scale, you're starting to get to a closer and closer to maxing out what seems plausible. And then what oftentimes can follow is kind of a more long, drawn-out correction before a more long-term move to the upside is possible. So what you're going to see is this dynamic where long-term UDPI can be high while short-term UDPI is whipsawing back and forth. You can have multiple kind of rallies that are reflecting the short-term UDPI going up and down, while the long-term UDPI kind of stays at an elevated level, because it's not concerning itself with that short-term volatility. It's saying, in the coming months, is it likely you're going to be seeing, meaningful upside later, or is the meaningful upside really getting exhausted? And if that's the case, then you oftentimes need longer, more protracted periods of downside to get the long-term UDPI to cool off to see that. We can see that if we just look at some examples. So for example, I'm just going to go back here to our first page. I'm just going to go ahead and click. If you didn't notice, you can just click on an asset to bring up the chart for it. This is the Bitcoin long-term UDPI. And what I'm going to do is I'm going to add the short-term UDPI over top. So I'm going to just add the short-term UDPI over here so we can get that direct comparison I was just talking about. So now we have the teal is the long-term and the yellow or orange is the short-term. And I think a great example of this time where you can get kind of this dynamic where you're having really extended to the upside long-term UDPI, but then these bounces in the short term is what happened here going into the spring and then the winter and then spring of 2021. We'll see in this massive rally that Bitcoin had, the short-term UDPI shot up here, marking this local top. We had a pretty sizable correction, marked the local bottom right around down here. Off to the races we went again, marking the local top again. Whereas the long-term UDPI, it was saying that generally speaking, we're getting overextended. Things are getting risky up through this whole time, and a more sizable downturn, which we ended up seeing down here through the summer, was likely to play out. And then even with this kind of relief rally, you saw similar kind of dynamics play out as we went on through. And so the importance of that and why I highlight it is that the more extended we start seeing things get on the long-term UDPI, the less and less confident I am that the market can continue having meaningful blasting rallies to the upside before reaching an ultimate kind of at least local top. And so I think as this dynamic plays out, if we do see another relief rally, or not to say relief rally, we just see another rally in the market like we saw here, we see another leg up. If we continue to see this dynamic where long-term UDPI continues to get hotter and hotter and hotter across the board, that will make me a lot more skeptical of the ability of that rally to continue. Playing those short-term UDPI movements becomes a lot more risky and a lot less attractive when you're doing it in a context of really overextended long-term UDPIs versus context where the long-term UDPI is quite far in the negative, suggesting that moves in the coming months can move quite far before you're likely to start tapping out. We're now in a different environment. That's really just what I'm trying to say here. The environment has changed. We're no longer in that situation where everything was massively oversold across time points. Now we're at a situation where things are getting more overextended on the long-term UDPI and the medium term, where now with these whipsaws that we're going to be seeing in the short-term UDPI, it might become less and less attractive or less and less diagnostic of another new leg up coming anytime, especially soon. Essentially, you might be playing with some of the deeper negatives on this metric in these kind of environments than we would have expected going into the rally at the beginning of the year. So I think generally speaking, when you look at this is not to preclude the possibility of a new leg up. What I think it does say, and which I think, in some ways should be intuitive, is that we're getting closer and closer to the end. And I put out a tweet a while ago, and I'll repeat it here. I think if we do get another sizable leg up in the market, the probability of it being the last leg up are pretty reasonable. They're pretty decent of whatever that move might be being kind of the last move up. Now, it doesn't mean that it can't be fairly explosive or even get us up to some of these higher levels that we haven't seen for a while. So if we look at Bitcoin, for example, a rally back up into, the high 20Ks or even to the 30Ks could very well be up in the cards. But I think what you probably start to see in that scenario is these long-term UDPIs start to really raise warning signs, like we've seen in the past with these kind of rallies, like for example in 2019, which would then suggest that, a cool-off period, a more deep and protracted cool-off period is quite likely. And we could already be seeing that, right? This could already be as much as we can hope for, and we might end up going back down, and then maybe, have to hope that we can hold some of these higher levels of support, and not break down to new lows. But I think we could go either way. And so really, ultimately, what I'm seeing here is a less rosy bullish picture as it was painting all the way up through that rally, but the possibility is either way. And so I think you could kind of interpret these one way or the other, depending on what else you're looking at in the market. So let's move on to the next indicator I want to talk about here, the momentum bias indicator, or MBI. So this quantifies momentum in a given asset. Is it prevailing to the upside or to the downside? And what you'll notice with this indicator, so I'll go ahead and sort it here from highest to lowest, is that actually most assets are positive on their momentum, right? You can see that most of them sitting above zero, with only 3 XRP, BNB, and Quant sitting down below. So what does that mean? Is that a sign that we should still be bullish? Is it bearish? Well, I think the nice thing about the MBI is that it gives us a lot of different information. So I've in the past usually shown the MBI in the context of Bitcoin. I wanted to show an asset that I rarely talk about, just to show how these same behaviors that I've talked about a lot with Bitcoin and Ethereum play out the exact same way with something like Litecoin, being another asset that has a lot of price history, and in some ways has behaved a bit differently from assets like Bitcoin and Ethereum, being something that's kind of more or less traded sideways for a long time, ever since the bull market that got it into 2017. Well, you'll notice on the MBI on Litecoin, and this happens with every other asset that you look at, is that you have distinct patterns of behavior. Where in bullish periods, you're spending a lot of time up in the green, positive momentum bias prevailing, which can really allow price to shoot up. And then in bear markets, you're going to see this prevailing downside momentum with occasional attempts to reestablish positive momentum bias to get rejected to the downside. And then you'll kind of have these periods where you start oscillating around zero. I think the Litecoin shows it most distinctly here, these accumulation zones where you kind of spend a lot of time just hanging out around zero, kind of this midpoint between bullish and bearish momentum, which can then set the stage for these massive bull runs. So you kind of see it more or less coming through here, this kind of small bullish period, this small bearish period, kind of oscillation period here, this accumulation, and then off to the races into the bull market. And now you're seeing with Litecoin, and actually with a lot of other assets, is it's starting to look a heck of a lot more like this kind of behavior, or at the very least this kind of behavior, than it is like a bear market behavior. That throughout 2022, we had, from late 21 into 2022, we very much had bearish behavior going on with the MBI. Now we're starting to look something more like this, or actually for Litecoin, going into its halving, which is coming up later on this year, maybe even something a little bit more like this. And so what that might tell us from a more macro perspective is that if we kind of zoom out, even if we're going to see, the current rally start to peter out for something like Bitcoin, we come back down and we kind of chop sideways, what the MBI might be telling us is that maybe what this is just a more protracted accumulation zone. And that, instead of being too worried about us shooting off to the moon right now, which obviously everyone usually wants it to be right now, people tend to be fairly impatient. What it might mean is just that for those who are willing to bide their time, if we continue to see this behavior play out, it might just be more and more evidence that we're heading into a bullish setting that's actually really worth the wait, where you actually are going to see those gains. To not be impatient and just kind of wait it out. And again, I'm showing you Litecoin, but it's happening with Ethereum, it's happening with Bitcoin. You're seeing these kind of behaviors start to emerge on the MBI that we really haven't seen since this bear market had begun, back late 2021. So I think when I look at the MBI, I see it more as something that can tell us about the broader macro picture. Where are we in the market cycle? And what I'm seeing right now is even as some assets dip into the negatives, I don't see that as being especially bearish long term, because that's just what you'd expect. That even in these periods where things kind of go sideways and maybe don't feel very bullish, you kind of need those periods in crypto often to set the stage for those bull markets. So I think in kind of the more long-term perspective, even if we do see a pullback, and even if the long-term UDPI gets a bit overextended like it did back in, for example, 2019, it's going to go back to the Bitcoin one, we can see this happen. Look at 2019, the long-term UDPI got all the way up to just under 2. Imagine that plays out again, we get this kind of long drawdown that may or may not have a capitulation. That's kind of a extreme event with the March 2020 crash. But this more or less just kind of drawdown or kind of sideways action that's really maybe just setting the stage for some more upside from there. And so I don't think that anything that we're seeing on the UDPIs are precluding more bullish footing in the longer term, but I think they do call into question the continuation of the more recent upswing that we've seen in the market here. And another indicator that we can look at that I think paints a much more bearish picture for the short term, this rally that we're seeing right now, is if we move on here to the TCI, our trend confidence indicator. So what this is going to be getting at is how confident should we be in a given trend? Should we if we're in an uptrend like we are right now, or at least we had just been in an uptrend very distinctly in a lot of assets, should we be confident that uptrend is continuing, or is there weakness starting to form? And the critical thing is that if you're in an uptrend and the TCI flips into the negatives, that is a bad sign. And look at what's going on with the TCI. The majority of the assets that we are following are in the negatives, with some being quite deep, some just being a little bit there, but very few assets being positive, and not really especially positive at all, kind of weak there. And most of these are going to be in a downtrend on their TCI levels. So their TCI levels are descending. And why is this important? Well, let's look at Ethereum as an example. Again, I've often talked about the TCI in the context of Bitcoin. Let's talk about a different asset and see how we can see similar patterns play out with it and how we can start to interpret it. So again, it's an oscillator is the way that you can look at this. And so, if you're above zero, that's kind of bullish. If you're below zero, that's bearish. And especially what you want to look for is these kind of dislocations, these times where, for example, you're in an uptrend, but then the TCI flips negative. So you're moving up, and then you see this weakness in the TCI that tends to portend or come before corrections, before, reversals in the trend. So, you're kind of having this downtrend then. See the TCI flip green, and oh, look, we had a nice little relief rally, flip down negative, down we went, flip green, oh, look, nice little relief rally, get weak, go down to zero, then fall below, downtrend, and now we've just been kind of chopping around. We did flip kind of quite bullish in this move up for Ethereum, but now you'll see weaknesses starting to re-emerge. We're not at a point where the model is especially confident in the uptrend continuing. You see confidence was falling this whole time. Now it's relatively undecided, if not a little bit bearish. And that might be a sign or a signal that we might have more downside to come with this short-term rally. That even though we've been holding sideways, we might actually start to see a correction. That doesn't mean that the broader trend can't continue. So we look here, there were multiple times where it dipped down negative, then went positive, dipped down negative, then went up positive. What it did end up pretending is that there were these times of breathing room necessary and ultimately correction. But we did move down noticeably, from these local highs down to these local lows for ultimately setting the stage to go back up. And so when you're starting to see this weakness across the market, it calls into question the ability for these assets to immediately move back to the upside. You might actually think that more downside could be reasonable coming from here. So that's a rather bearish kind of potential indication. And especially when you're seeing uptrends where there's also negative TCI values at the same time, that's especially the time when you might want to get concerned. So if we're looking at kind of a short-term bearish piece of data, I would say that what we're seeing with the TCI right now is exactly that. So who knows? We'll have to see how it plays out. Anything's possible in crypto, and this, we could just see a reversal back up. That really these negative TCI values we're seeing might be as bad as it gets for this correction. We have been seeing at least a short-term correction, could be as bad as it gets, and that these signals are already played out as far as the downside is going to happen before we can start pushing back to the upside, and then these will start to reflect that as well. But it's too early to tell, and I think that, in the past when this kind of thing happens, it's much more of a bearish indication than bullish, and so that's why I'm not ready to write this off as just being nothing to worry about. I think this is an important thing to keep an eye on. Okay, so let's talk about the final indicator we have here, the MDC, or Market Direction Classifier. So this one is very easy to interpret. It basically gives a price level above which it's bullish, which means that it thinks an uptrend is more likely than a downtrend. But then if you lose that level, if you fall below it, that's the opposite. Then a downtrend seems more likely than an uptrend. And especially when you see a decisive breaker above or below is when you might want to take that as being kind of that signal of, the fun's over if you fall below after an uptrend, or maybe the fun can begin if you flip above if you've been below it. Now, what's interesting here is that the MDC is not going to be calling weakness as quickly as the TCI, apparently. When you look at the difference here, the TCI is already saying that there's a lot of weakness in the market. MDC is not quite there yet. So if we look, there's only two assets, Quant and XRP, that are below their MDC levels. XRP just a little bit, Quant just a little bit here as well. But then these other assets are still above, some still being well above. Bitcoin's MDC level right now is just a bit above 20K. Bitcoin's still trading at 23K. Quite a bit of wiggle room that it still has. Same for Ethereum, for example. And so really, I would see the MDC as being a confirmation of what the TCI is saying. That's one way that you can kind of think about that. The TCI can sometimes give early warnings of trend reversals, of when a trend is looking too weak and likely to reverse to the downside, for example. And then the MDC, if you start seeing a bunch of things flip into the negatives there, you can see that as being confirmation. That really, that's kind of maybe the last straw, or just kind of a point at which then downside becomes more definitively kind of the bias, and maybe the side that seems more realistic. And so that's what I'm saying. What I'm seeing here is that if this TCI does lead to weakness, look and see if we can hold these critical levels. If we can't, if we fall below them, especially if we decisively fall below them, not even necessarily on all of them, but just on some assets, that's going to be another indication that this rally we've been seeing might be at its end, and we might actually end up having to go and test lower levels that we haven't seen, since the beginning of this rally, since the beginning of the year. So we're still not there yet, but it's something, in my opinion, to keep in mind. And if we just look at the MDC as an example of it, so here I'm just showing you Bitcoin again, you can see how it tends to do a good job of early on identifying these uptrends, but then also early on identifying these downtrends. And then I think when you use it in conjunction with something like the TCI, it can be especially powerful, where the TCI can sometimes give you early warnings of potential weakness, and then the MDC can give you confirmation of that signal should price fall in this case, or rise, if you're going the other way around. So those are kind of what I'm seeing across the data that we have on the website, and just looking at some of these factors here. Where generally speaking, and it's maybe not that satisfying of an answer, but it's just the honest opinion here, I think we're at a crossroads for the market. And I think for me personally, I do not have a particularly strong bullish or bearish bias on the market right here. I think it's totally feasible. We see another leg up when we get back for Bitcoin, for example, up into these higher 20Ks or maybe even 30K levels. There's some on-chain, don't have time to get into it here. Maybe in a future video, I'll talk about that. Some on-chain reasons why you think that we might be able to clear through these levels relatively quickly before finding resistance at some of these levels. But it's also very possible that this plays out as a classic rejection off of key technical levels that sends us back down to 20K, 19, 18, or, God forbid, maybe even down back to the lows, or in the worst case scenario, especially if we see the stock market fall off a cliff or something like that, actually setting new lows. But I think new lows are really only in the cards. Well, I shouldn't say only, but they're much more likely to be in the cards if we do see catastrophe in broader markets and the stock market relative to anything else. If the stock market just kind of chops sideways from here, or is only kind of weakly bearish, I think there's a decent possibility, even if we have to go down to these lows, that we could hold them. But if we see chaos in the stock market and broader markets, I don't see why that chaos wouldn't extend to crypto as well, and there'd be no reason to expect that these lows back from late last year would necessarily have to hold. So that's going to be something that we're also going to have to watch, of course. But, watch these data. Basically, just watch it. And then inform your priors, inform your biases based on what you're seeing. And so again, the things that I'm going to look for just really quickly are what happens with the UDPI long term. Can we see a sufficient cooling off of it to allow more extended upside if we kind of chop sideways? MBI, can we start seeing that bullish behavior continue across assets? TCI, is this going to lead to the weakness that it's projecting? And then maybe even most critically for the short term, do we start losing all these MDC critical levels? That could be a very bearish sign. All right, if you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. A lot of updates about indicators and more over there. And come check out the website at polaritydigital.io. Link is in the description.